Hey everybody, welcome back to our channel. I am Cindy Appleman, and today we are diving into a super fun topic that could actually save you thousands of dollars. And guess what the topic's called? Mortgage refinancing. That's right, we're going to talk about refinancing. Now, if you think refinancing is just a boring financial topic, think again, because I'm here to show you that it can unlock major savings and help you reach financial freedom faster. So whether you want to lower your monthly payment, pay off your home sooner, or even tap into your home's equity for cash, refinancing your mortgage could be the solution. So stick around and we're going to talk all about it. So how can you save thousands of dollars? Let's break down the key factors that make refinancing so very valuable. One thing we need to do is understand interest rates and how they affect your mortgage. You are not just lowering your monthly payments, you're saving thousands of dollars over the years. So again, we're going to break this down with an example. Suppose you have a $300,000 loan at 7% interest, dropping that to a 5.75, which is only a 1.25% reduction, could save you $246 a month. That's over $2,900 a year. And if you calculate that out on a 30-year term, you're actually saving over $100,000. So when do you know when is a good time to refinance? Generally, it's smart to refinance if you can reduce your interest rate by at least 1%. But sometimes even a 0.5% drop could make a difference depending upon your loan size and the remaining term. Refinancing can also help you shorten your loan term. For example, from a 30-year mortgage to a 15-year mortgage. This means you'll pay off your home faster and reduce the amount of interest you pay over time. Again, let's take another example. If you refinance a $300,000 loan from a 30-year term at 6% interest to a 15-year term at a 5% interest, your monthly payment may go up by $574, but you could save tens of thousands of dollars in interest. In fact, you would be mortgage-free 15 years sooner too. That's kind of cool. Okay, so let's take a quick example. Your payment would be around $2,372 on a 15-year term at a 5% interest rate, $300,000. Your payment would be around $1,798 on a 30-year term at a 6% interest rate. When calculated out, that is $220,029 in savings. And it cuts out 15 years of the mortgage payments. So you pay off your mortgage 15 years sooner and you save over $200,000. As long as you can afford that higher payment, seems like a no-brainer, right? So something else to consider, a cash out refinance. What is a cash out refinance? Cash out refinancing lets you borrow against the equity in your home, giving you cash that you can use for things like renovations. If you want to put a new kitchen, a new bathroom in, a garage, you could also pay off high interest debt or other big expenses, maybe even take a family vacation, who knows? It's a powerful way to use your home's value to achieve financial goals. So what would be an example of a cash out refi? Say your home is worth $400,000 and you still owe $250,000 on your current mortgage. With cash out refinancing, you could refinance your mortgage for say $300,000, take $50,000 in equity out, use that cash, and still have a loan with potentially better terms. So, when should we consider a cash out refinance? This option makes sense if you need funds and want to consolidate high interest debts like credit card, or if you have a higher interest car payment, student loans. But just remember, it's essential to use this cash wisely as you're still adding to your mortgage balance. But warning, be cautious here. You're using your home as collateral. So if you can't make the payments, you could be risking foreclosure. Make sure you can afford the payment. When done right, cash out refis can be a great way to access funds at a lower interest rate than using a credit card or getting a personal loan. Let's talk about adjustable rate mortgages versus fixed rate mortgages. All right, so if you are currently in an adjustable rate mortgage, which means your rate can adjust per year, per 2 years, per 5 years, depending upon your terms, refinancing to a fixed rate mortgage can save you money and provide you peace of mind. ARMs, otherwise known as adjustable rate mortgages, are great initially because they often have lower rates, but they can change sometimes dramatically after the fixed rate period ends. So why refinance to a fixed rate? With a fixed rate mortgage, you lock your rate in for the entire term. which means no surprises down the line. It's especially helpful in a market where rates are rising, such as kind of what we're in right now. So I've seen clients with adjustable rate mortgages refinanced into fixed rates and actually save hundreds monthly while avoiding the stress of fluctuating payments. So now let's calculate what your break-even point might be. What is a break-even point? The break-even point is when the savings from the refinance start to outweigh the cost of the refinance itself. It's crucial because refinancing comes with closing costs, usually 2 to 5% of the loan amount. So how do we calculate that? Divide the total closing cost by the amount you'll save each month with the new mortgage. If you're saving $200 a month and your refi costs are $4,000, it'll take about 20 months to break even. If you plan to stay in your home longer than the break-even point, the refinancing could be worth it. If not, you might want to reconsider a refi as you won't fully recoup the cost. So let's review fees and closing costs. You need to know the fees involved. Refinancing is not free. There are closing costs, appraisal fees, loan origination fees, and potentially points to lower the rate. These costs can be thousands of dollars. Some lenders offer options to roll these costs into your loan balance so you don't have to pay them out of pocket. This option might raise your loan balance slightly, but can make refinancing more affordable. If you're finding value in this video so far, give it a thumbs up. So what we want to do at this point is shop for the best deal. Don't hesitate to shop around. Different lenders offer different rates, terms, and fees. Compare loan estimates to find the deal that gives you the best savings. Once you have found a great rate, locking it in is crucial. Rates can change quickly. Literally, I'm telling you quickly. They might be 5.75 now, and in 15 minutes, they went up to 6. And then in 15 more minutes, they drop down to 5.75. So this is really critical. When you find a rate you're happy with, lock it in right away. Most rate locks are between 30 and 60 days, but ask your lender if they offer a longer lock option if you think the process might take longer. Listen, the longer the rate lock, the more it's going to cost. So you need to know that. The shorter the rate lock, the lesser the fee to lock, if there's a lock fee at all. A rate lock gives you peace of mind, protecting you from rate fluctuations while you are finalizing the loan. So what are some common mistakes? Mistake number 1 is refinancing too often. Have you ever known of someone who purchased a house for $100,000 20 years ago and they refinanced it so many times that now they owe $200,000 on it? They probably refinanced it too many times. So refinancing too frequently can eat up all your savings and all the equity in your home. Each refinance comes with costs, so only refinance when it makes financial sense. Mistake number 2, not considering loan term impacts. Extending your loan back to 30 years every time you refinance might lower your monthly payment, but increase the total interest paid over time, which is kind of what I was just talking about in the example. Mistake number 3, not shopping around. Don't settle for the first lender who offers you a rate. Comparing offers could uncover savings you'd otherwise miss. It's not to say that you don't go back to the first lender that offered you that rate. Maybe they are the best ones, but make sure you shop around so you get the best rate. So let's recap. Refinancing can be an incredible way to save money, pay off your home sooner, or access funds for other needs. The key steps are to compare rates, consider terms, calculate your break-even point, and shop around. If you're interested in refinancing, talk to multiple lenders. Do your calculations and make sure the timing is right for you. And if you found this video helpful, don't forget to hit the like button, subscribe, and share it with someone who might benefit from refinancing. Thank you so much again for watching. Here's to saving thousands with your right refinancing strategy, and you've got this.